Reaching your first $100,000 is often the hardest part of building wealth. It can take years of saving, investing, and saying no to things you want in the moment. But something changes once you cross that milestone. The way your money grows starts to shift. You're no longer relying entirely on your own work or savings to increase your net worth. Your money begins working for you in a noticeable way. And if you handle this stage correctly, you can quietly move from $100,000 to $1 million without taking extreme risks or chasing complicated investments. This point in your financial journey is what I call the wealth acceleration point. The wealth acceleration point happens because of compounding. With small amounts of money, the percentage gains you earn don't feel like much in dollar terms. For example, earning 7% on $10,000 is only $700 in a year. But earning 7% on $100,000 is $7,000 in the same period. That's a vacation, a used car, or months of living expenses, produced without you doing any extra work. And here's the important part. If you reinvest that $7,000 instead of spending it, the base you're compounding on becomes even larger, which then produces even bigger gains the next year. This is where the snowball starts rolling on its own. The challenge is that many people hit $100,000 and start loosening up. They feel like they've made it and begin spending more freely, upgrading their lifestyle, or even withdrawing from investments for things that could have waited. The problem is, every dollar you take out now is a dollar that could have been earning for you over and over for years to come. The number one rule in this stage is to protect your base at all costs. Treat your $100,000 as if it's untouchable. Your future wealth depends on keeping it intact and adding to it, not chipping away at it. A big part of protecting your base is managing risk differently than you did before. When you were working with $5,000 or $10,000, you could afford to make mistakes because the dollar amounts lost were smaller. A bad investment or a speculative move might have set you back a few $100s, which you could recover from quickly. But a 20% loss on $100,000 is $20,000 gone, and recovering from that could take years. This is why experienced investors often move toward a more balanced, diversified portfolio at this stage. Instead of putting all your money into a few individual stocks or high-risk ventures, it makes sense to spread it across a mix of assets. Broad market index funds for growth, some bonds or cash equivalents for stability, and maybe a small slice for higher risk opportunities if you understand them well. This balance helps you protect your progress while still giving you room to grow. At this point, taxes also matter much more. When your portfolio was smaller, losing a few $100s a year to taxes might not have made a big difference. But now, even a small percentage saved on a larger portfolio can add up to thousands over time. If you save just 1% in taxes each year on $100,000, that's $1,000 that stays invested and keeps compounding for you. Over a decade, that could mean several thousand extra dollars without any additional effort. Using tax-advantaged accounts where possible, like retirement plans, IRAs, or similar local options, can help minimize what you owe each year. This is also the time to understand capital gains. Knowing when to sell and how to time withdrawals in the future can save you significant amounts. Even something as simple as holding an investment for over a year to qualify for long-term capital gains rates can make a difference. Automation is another habit that becomes even more powerful at this stage. Set up automatic contributions to your investments every month, ideally right after you get paid. This way, you're never tempted to spend the money instead. If your income increases, adjust the amount upward so your lifestyle doesn't expand faster than your investments. Even adding an extra $200 or $300 a month to your contributions can shave years off your timeline to $1 million. The key is to make these contributions happen without requiring a decision each time. The less room there is for hesitation or distraction, the more likely you are to stay on track. While keeping expenses under control is still important, your focus should now be on avoiding large, irreversible commitments rather than cutting every small cost. You don't have to live like you're broke, but be cautious about locking yourself into a bigger mortgage, a new car loan, or expensive recurring memberships that tie up large portions of your income. Every big fixed expense reduces how much you can invest each month, and at this stage, those monthly contributions are what drive your wealth forward. The faster you can add to your investments, the more noticeable the acceleration effect will become. Reinvesting all your returns is essential to take full advantage of compounding. If your portfolio produces dividends, interest, or rental income, send that money straight back into your investments instead of spending it. This step is often underestimated, but it's what makes compounding truly powerful. Over a decade, reinvesting those payouts could add hundreds of thousands of dollars to your total. Skipping reinvestment, even for just a few years, slows your growth and delays the point where your investments start generating enough to meaningfully change your lifestyle. Your income is still the fuel for your portfolio, so finding ways to grow it will make a difference. Negotiating raises, learning new skills, or building a sustainable side project can provide extra cash to invest. Even if you can't dramatically increase your income right away, look for ways to direct more of what you already earn toward investments. Every extra $1,000 invested now has the potential to turn into several $1,000s over time without any extra work from you. Over a span of 10 or 15 years, that difference becomes substantial. It's also time to shift your mindset from short-term to long-term thinking. Market drops will happen. Your portfolio might lose value for a year or two in a row. This is normal and doesn't mean your plan has failed. As long as you stay invested and keep contributing, those downturns often turn into opportunities. Buying more when prices are down means you'll own more shares when the market recovers. This patience is a major part of why the acceleration point works in your favor. The longer your money stays invested, the more powerful compounding becomes. One common pitfall at this stage is overconfidence. Seeing your portfolio grow from $100,000 to $150,000 or $200,000 might make you feel like you've mastered investing, but markets have a way of humbling even experienced investors. Stick to your plan, avoid making big changes based on headlines or short-term trends, and keep your risk levels appropriate for your goals and time horizon. Consistency beats reacting to every piece of market news. If you want to speed things up further, consider ways to combine consistent investing with occasional lump sums. For example, if you get a tax refund, a work bonus, or sell something valuable, send part of that directly into your investments. Those extra boosts, especially in the early years, can bring your $1 million goal much closer. You should also start planning for what happens once you hit $1 million. Will you continue growing it? Will you shift to living off part of the returns? Having a plan for the destination keeps you from making short-term moves that could slow you down. Many people find that $1 million isn't an endpoint. It's the point where they can work less, take fewer financial risks, and make decisions based on preference rather than necessity. At this stage, protecting against life's unexpected events becomes more important too. Have an emergency fund so you don't need to pull from investments when a surprise expense comes up. Make sure you have the right insurance, health, income protection, and property coverage to prevent a single event from undoing years of progress. Regularly check in on your progress. Quarterly or yearly reviews are enough. No, don't obsess over daily fluctuations. Use these reviews to rebalance your portfolio, adjust contributions, and confirm that your plan still fits your goals. The review process keeps you on track without letting short-term emotions interfere. The wealth acceleration point isn't about finding the perfect investment or guessing the next big opportunity. It's about continuing the same disciplined habits that got you to $100,000, but now with a stronger base and a greater focus on protecting it. Your job is to keep adding to it, let it grow, and avoid big mistakes.